Hey, everyone. This is Warren Howe. Hope you're having a great day as always, guys. You guys know the drill. Today, we'll be talking about business, all things business, right? What's the best way when the markets are all dropping and we don't look at a business, we look at the fundamentals so that we can determine whether or not we want to hold over the period of time. We look at the sector. You guys know the drill. If you have been following up on our videos, following up on our style, you know that we go for momentum trading, we go for long-term investing. It's a mix and match, best of both worlds. So appreciate it. Again, if you guys can smash that like button, smash that subscribe button if you haven't, smash that heart button, right? Because you're actually watching this live right now. Yeah, so we're going to be talking about business, cash flows, what is called owner's earnings, right? And intrinsic value. So I want to do this like a two-part session. Just basically break down part one and part two. And yeah, I want to make this as educational as possible for those, because this is especially relevant in these times right now, because we want to be assessing cash flows. We want to be owning companies that basically have cash flows. Want to be owning companies that has a decent intrinsic value, because that's what the whole market is. The whole market is in a re-rating situation, as we all know. So in a re-rating situation, we need to be in we need to demand a better discount on valuations, right? Simply because, okay, this company doesn't really have the growth trajectory, affected by the Russia war, affected by cost of revenues, affected by, freight costs, whatever it is. So they do not, deserve that valuation as a growth company. So what do? We have a stress test. So the best stress test, in my opinion, other than the things we mentioned in previous videos from balance sheet, we looked at Shopify, right? Last video. Other than that would be, what are the cash flows that this company can generate, right? So you can argue all you want, right? The stock market is dropping. Yes, it's true. The stock price is dropping for these type of companies. Yes, it's true. But it's the underlying fundamentals that will back it up. So let's say if the recession lasts for probably about 18 months, who cares, right? They can still have a good balance sheet to survive. They can still have good cash flows to support. If their net income drops, it doesn't matter, because they can survive. That's the whole game. So do not take this session just by its own. Again, investing involves a lot of metrics, involves a lot of analysis, right? Qualitative wise, quantitative wise, and whatnot. So let's jump in. Okay, I've been talking too much. Let's jump in. And I am going to just adjust a little bit. Sorry for the wait. And I want to be explaining about my, live scenario on, I'm going to be basically sharing my real life experience of owning a company, trying to own a company, right? So I own a couple of small businesses, private. I'm actually on the lookout for owning more, right? It's a recession in the US because oil prices affects everything, right? I mean, oil prices affects plastics, affects everything that we consume every day. So it's like a ripple effect, right? And now oil prices at 120 a barrel is like close to, not mistaken, $7 to $8 a gallon, which is devastating, because that's like additional in dollars, right? That's like additional few hundred, right? Close to 1,000 a month on consumers. So that's a problem. Now, it's not really that affected in Malaysia, my country, simply because, the government subsidizes the petrol. So if I drive a Tiguan and I want to pump full tank, it's like 120 ringgit, which is divided by 4, that's like $30, right? USD. That being said, though, it's a pinch because it's higher than before for Malaysians, right? So we are still complaining, but what I'm trying to point out here is that we are not as affected. In fact, I just left drinking with my friends on the afternoon, and then night, the brew house, company here in Malaysia, bar in Malaysia, is all full, packed. Uncle Don is packed. So I was also talking to my friend who owns a hair salon chain. I'm thinking, but there's so many opportunities here, and I'm reserving my money onto cash flow generating businesses And that's relative to what we should do, today. I mean, US, anywhere in the country, private businesses to generate cash flows. If you want to concentrate on stocks, then that's fine, but make sure they also produce cash flow, which we're going to talk about today, right? So the reason why I separated part 1 and 2 is because we need to understand the whole idea. For those that are new to intrinsic value and cash flows, this is, a good session for you. So here's the thing, right? When I wanted to so here's before COVID, okay, this is my story. I got pitched to buy over a baby sensory business. Yeah. And I sent my kid there, my daughter. I sent her there. It's in Montclair, and it's all good. And I like the business. It's so simple, right? All you need is like literally one staff. You are the head, obviously. One staff, low maintenance, right? Low capex. You just need to pay your rental, which is cheap as shit. You just rent the, first floor shop, which is 1,500, 2,000 a month, ringgit. So it's a low maintenance business, right? Low capex. And you can charge per parent, and you're in an expat place, so the location is good. Yeah. So it's just like one session around 80 bucks, 80 ringgit. So you add that up, the occupancy, I mean the rate is good, right? It's solid. I go there sometimes on the weekdays, on the weekends I see a lot of parents. Every time the class, easily 10 kids, right? So I can work out the maths. If I can, times by a month, how much I can get, what's my cash flow, all that. So that's why I'm going to use this as a case study. And that's why owning businesses is relative to owning stocks. We don't just look at, fucking prices on the chart and let's say sell now, buy now. It's much more than that, right? So, just to share with you guys, this was actually the document sent by, the previous owner. Yeah. And she gave me all the costs, right? All the feasibilities. I just have to do my DUD and I see whether it's feasible. It is very feasible, in fact. So the idea is that it has a good market fit, right? That's what I have to assess. So it's all relative. It's not just numbers, right? Good market fit, product market fit. You just have to pay literally royalties to the ownership in UK, which is Baby Sensory. 12% is not too bad on revenues, right? All the systems all worked out. That's what you pay the royalties for, right? You got syllabus, you don't need literally no brain work, just execution. All you got to do is just study, go into the test, study it, teach it to the kids. Okay, that's all, right? Nowadays, people are willing to spend, even for sensory, right? Spend on their kids. So I love it. I love that fit. Low rental, you know the drill, right? So that's all the breakdown. Manager, main teacher, utilities, sundries, blah, blah, blah. Capital costs, which is she's selling the business for 280,000 ringgit. Useful life 6 years. She determined sort of 6 years, right? So then there's a breakdown of cash flow. So the number of students, because she was saying that on the aggressive days, it would be around 250, but we were conservative and said, okay, 175 students for that month, right? So you times by on average of Q5, right? You times by an average of I think it was fees per student, right? 200 bucks a month. Then you can get this revenue, right? You times by 12. So what this is actually projecting is revenue projection of 388,000 for the whole year, year one. Okay, it's not a lot. It's a small business, right? It's a very small business. It's a very cheap business as well. But everything that we do today is relative to owner's earnings. And if you get and grasp a very simple logic on this table, you can grasp a simpler, you can sort of dissect stocks, right? Because stocks is much more complicated, it's bigger numbers, but we're gonna, sort of dissect Apple in a bit later, right? So year one, 388,000. Now, when they present this to you, we got to do our due diligence, obviously. We got to assess whether or not 175 students is reasonable. For sure, right? Business 101, guys, right? So that's what we're discussing here today. So 175 students, is that reasonable? Okay. For the whole year. And then are they recurring? Does the fee work? Does the 200 bucks a month work? All this sort of stuff. So what you do is, if that numbers work out, then you can get 388,000 for the year. Is that reasonable? If you want to be conservative, then put a 70% or 80% on that figure, then you can have a decent amount, right? So that's bear case, conservative case, bull case, right? So then we got royalties, which is a 12% fixed on the revenues, okay? And then you got a net revenue of 342,000. Again, we have to assess whether or not that's logical, okay? Then after that, you have to assess all the operating expenses or even relative capex. Now, in this type of business model, there's no capex. We're going to be talking about capex later on, but it's all OPEX, right? It's rental for the year, how much it's well, sorry, just now I said 1,500 to 2,000. I think it was not that low. It's definitely around 4,000 range. I forgot, right? Because it's first floor in a good location like PJ, so it'll demand around 5,000, whatever. So, and by the way, there's 2 units, right? Because they need, like Baby Sensory, they need a bigger space. So after that, you get rental, you got the main teacher or manager, and you assess by having 175 students, how many teachers do you need, right? Then you have others, which is miscellaneous, and you add on other factors. Then you got admin, who's just managing the receptionist table and whatnot. Then you got a total of 119,000 for the year, which is just around 12,000 or 13,000 a month, or maybe less than that. So then you assess whether or not it's a viable business, because you're already assessing the cash burn. Yeah, you're already assessing how much you need to spend literally if you have zero revenues. And bear in mind, this was before COVID. Okay, so everything that we do here, we have to exactly implement it on the stocks that we are doing. It's so simple, right? We're looking at this simple Excel sheet, and we don't do it for our stocks. What do? We complain and we look at the stock market. So far is at 4, so far is at 5. Why is it going down? And we just look at that. Why don't we talk about business fundamentals? This is what I'm talking about, right? Then we got operating cash flows. Now, operating cash flow is key because it takes the revenue minus the how much is spent, and then we have operating cash flows. Now, this is simple because it does not incorporate loan. It does not incorporate interests, right? So again, we have to put in the extra work to do that for our listed companies. Obviously, there's more things to factor in, but if we can just streamline the core, right? Streamline the core issues of what is needed to spend on the business, what is the working capital, what is the cash burn, what is the capex, we get the cash flows. The general idea, that's what Warren Buffett is also saying, has been saying, that the price of the business is the sum of all future cash flows discounted by the current price. It's as simple as that, right? So you get the operating cash flow and you pay 280,000 for the business, cash, let's say, right? Without taking a loan, you have a negative 57 left to get back your investment. Yep. So again, you assess everything, right? From your revenues, from all the qualitative stuff that we talked about just now. And then it comes to year 2. Is there growth? Are you confident to grow it? You can be the conservative type on a stress test on your companies and say, okay, you know what? They're not going to have growth because macro economy, macro environment, blah, blah, blah. No one wants to spend money now, blah, blah, blah. It's not necessary now, blah, blah, blah. Yeah, let's say it's stagnant, no growth, whatever. But in this case study, 200 students instead of 175. So revenue goes up, royalties goes up. This doesn't go up, but it's not really accurate because it should go up, right? You need maybe another teacher for more students to cater. So this is actually wrong in that case, but we need to adjust accordingly. And again, this is just a sample case scenario, right? So then you have, your total OPEX is a little bit more. And then you got positive cash flows of 300,000 right now for the whole year, which just brings up to 20,000+ a year. Not too bad, right? But your positive ROI is already 244,000 because you only spent 280,000 for the business. Now, the key thing here is that we need to add up all these cash flows, yeah, because by year 6, you need to discount back to the price because of inflation. The value of money is actually going down in relation to time. Value of money actually goes down as we go on for the year, right? So in 6 years' time, your school fees might be a double or 1.5x more than today because of inflation. So we need to discount back the price. Now that discount rate is important. You could put it into risk-free rate, You could discount back into inflation for a more bear case scenario, whatever, right? But the quantum amount that we want to look at is close to 2 mil in cash flows that can be, brought back, accumulated in year 6, right? That's the key. So then it begs the question, would you buy this business for 280,000 if you can get 2 mil in 6 years? The answer is a hell yeah, I will, right? Because you're more than 10x the money that you are putting in. And that's exactly what we need to do for the businesses that we buy. I hope that makes sense, right? Because that's exactly what it is. Now, there's a lot of factors in comparison, obviously. There's a factor of this is a private business, so there's no PE inflated. It's a listed business, so there's always an inflated PE, as we know, right? It's ×5, ×10, ×8. But again, in this market environment right now, we need to demand a better discount. To demand a better discount, we need to fucking, get the cash flows. I don't care about PE anymore. Let me work out the cash flows, right? I want to work out how much cash flows this business can generate. And I want to pull it down to 15 years because I think that this business, if you pull it, here's the realistic scenario. If you do intrinsic value, you pull it down to 6 years, it won't work because, like, let's say Tesla, right? Now, that's why if you add up all the cash flows that Tesla can generate in 6 years versus the market cap, you'll never buy Tesla because the market cap's too huge. They already have that premium inflated, right? They have the technology, they have the gigafactories, there's Elon. Elon deserves maybe a 20 PE, whatever, right? So that's a little tricky when it comes to private business and stocks. But again, if we want to be really pressure testing our companies, looking at pure fundamentals, this is what I'm talking about, right? So again, you already know the concept of a private business. Hopefully you guys are making money on your private business. Let's talk about owner's earnings. Yeah, let's talk about owner's earnings for a little bit. Again, this is part 1, right? Part 2, I'll be revealing the spreadsheet. But let's talk about part 1 first. Okay, part 1. So part 1, what is owner's earnings? Yeah, and this is from Big Daddy B, Buffett himself. If we think through these questions, we can gain some insights about what may be called owner's earnings. These represent A, reported earnings, plus B, depreciation, depletion, amortization, and certain other non-cash charges. Yep, 1 and 4. Less the average annual amount of CAPEX for plant PPE, yep, that the business requires to fully maintain. So why is that? Okay, now this is very long, but it says one thing. Okay, it says the owner's earnings, for example, Apple, right, or any company. It says number 1, your reported earnings, which is your net income. Sorry, I think this is a better representation. Net income, because this is your reported earnings on a GAAP basis. Okay. Number 2, what is your depreciation and amortization? You add it back because it's already deducted from, we are working on cash flow today, right? So you have to add it back. It's already deducted from, it's actually not a cash expense, right? So you add it back, then you minus the working capital, because what is working capital? Working capital is basically your current assets minus current liabilities. How much room do you have to work with on the cash, right? Is your working capital. So you minus that back, you minus the CAPEX, because CAPEX is needed to maintain the competitiveness of the business, right? It's a necessary, right? It's a necessity. Yep. And bear in mind, net income already, so we talked about OPEX just now, right? Net income already encompasses all the OPEX already. So it's already taken care of. That's your net on the GAAP basis. Yep. That's why now we're working on cash flows. So, you add them all back, you minus the CAPEX. Again, that is necessary. And bear in mind, when we talk about interest just now, net income bears that as well. Yeah. So you get all that, you minus the CAPEX X amount, you can get Apple's owner's earnings. In 2019, it was close to 58 billion, so 57, right? That is owner's earnings. So what does that tell you? It tells you it's the similar concept that we did just now. Obviously, it's a different role because that doesn't encompass CAPEX. They have no CAPEX, right? Different business model, but it's the similar concept because what we did just now is to encompass the real cash flows for the owner Because if I own 100% of this business, I can literally cash out 222,000 and not put in any money back. It's mine. It's me as an owner's earnings. So in Apple's case, owner's earnings for the business. So if you are a shareholder of Apple, you'll be having, if you own 1% of Apple, you'll be owning 1% of 56B. Right? Obviously, it's not as simple as you cashing out because you can't do that, right? It's up to management's discretion. But the case study here is that we want to work out owner's earnings. You times by the remaining life that you want to own this company for, you discount it back to the price today, you add up the sum of all the cash flows, you can get whether or not the intrinsic value should be paid, right? So let's say Apple now is like 1.5 trillion, I'm not sure, 1.5 trillion. Does the cash flows work out plus the terminal value in over 20 years or 15 years? Does it work out to how much you're paying today, right? So again, there's few things to take in mind. Number one, the stock market always prices things more inflated than it should be. Why? Because they have, there's Apple, it's Apple, right? There's a brand there. The brand already commands a certain PE, they have growth, they have cash, they have blah, blah, blah. So in the stock market, there's always PE inflated. So that's why using this method is more discipline, right? Is another layer and it's more streamlined, it's more stress test on your company's as valuation, which is good because there are certain companies that requires cash flows, right? You can't do this on Tesla. You will never buy Tesla if you do this on Tesla, right? You can't work this on SoFi. First of all, they're not even profitable on a GAAP basis, right? So different methods to value different companies, obviously. But this is just to get number one, it gives you a good outlook of private businesses because that's all you need. Number two, you can relate it back on the stocks, whether or not they can generate cash flows for you and how much the owner's earnings. Number three, you can really work out on a core basis. Are you overpaying this company today, right? Apple is trading at 1.5 trillion. Would you be spending 10,000? I know it's just a spec, but would you be paying this company? I mean, would you be paying 1.5 trillion for this company? It's as simple as that, right? A lot of people, they don't ask this question. So that's what we're doing today, right? And this is part one. Part two, we're going to go through the numbers and determine intrinsic value. So yeah, I'll see you guys next week. I'll see you guys in the next video, and hopefully you had some value. Again, appreciate if you guys can subscribe, to our channel. Like this if you enjoyed it. Smash that subscribe button, smash that heart button. I'll see you guys next week. Bye-bye.